Over the last few episodes, we unpacked the first dimension of the three-part framework, custody. We covered the CEX single-point trust with rug pull risk, the AMM approval trap with honeypots, and the bridge risk on on-chain DEXs. Today, we move into the second dimension, execution, and we'll start with the innovation that kicked off the DEX era, the AMM, Automated Market Maker model. In episode 2, we focused on approval risk. Today, we're talking trading risk. Why is it that on Uniswap and similar DEXs, you might not get wicked, yet it still feels like you keep overpaying? Before AMMs, trading depended on an order book. You can buy only if someone posts a sell order. You can execute a sell only if someone posts a buy order. Centralized exchanges run that matching engine. AMMs are different. There is no order book. You trade person to pool, not person to person. The pool is a liquidity pool. Anyone can deposit two assets into the pool, say ETH and USDC, in proportion. Those depositors are LPs, liquidity providers. How is price set? By a simple formula, X times Y equals K, constant product. X equals the amount of ETH in the pool, Y equals the amount of USDC in the pool. K is constant. When you buy ETH with USDC, you add USDC to the pool. Y goes up. To keep K constant, the pool must release ETH. X goes down. With less ETH and more USDC left in the pool, the relative price of ETH rises. That's the AMM's brilliance, a transparent algorithm replacing the CEX's black box matcher. But that algorithmic pricing introduces 3 new pitfalls you don't see on CEXs. Pitfall 1. Slippage. Why do I keep paying more? Because price is set by X times Y equals K, the more you buy, the more the price moves against you. In a small pool, if you try to buy 100 ETH, your first dollars might fill around 3,000, but your last dollars could fill closer to 3,500. Your average fill ends up well above the quote you first saw. That's slippage or price impact. It's not the platform scamming you, it's the math. Pitfall 2. Sandwich attacks. Transparent stop hunts. This is the AMM version of getting wicked, but it's algorithmic and visible. Because blockchains are transparent, your pending transaction sits in the mempool before confirmation. Bots scan for large buys, then do 3 steps. 1. The bot pays a higher gas price, so its transaction executes first, buys ETH around 3,000, and pushes the pool price up. 2. Your trade then executes at the higher price, around 3,010, you're forced to buy higher. 3. Immediately after, the bot reverses the trade and sells the ETH back to the pool at around 3,010, locking in risk-free arbitrage. Your trade becomes the meat in their sandwich. They capture the price edge you expected to get. Pitfall 3. Impermanent loss. The LP's nightmare. This one hits liquidity providers. Many think, I'll deposit, earn fees, and relax. But you can earn fees, yet underperform just holding. Example. You deposit 1 ETH plus 3,000 USDC, total $6,000. ETH doubles to $6,000. If you held, you'd have $9,000, 1 ETH at 6,000 plus 3,000 USDC. In the AMM, the formula forces the pool to sell some of your ETH into USDC as price rises. When you withdraw, you might have 0.7 ETH plus 4,200 USDC equals $8,400. Fees might be $2,400, but the holder made $3,000. You're $600 behind the holder. That gap is impermanent loss. So yes, AMMs are a breakthrough. They use transparent math to replace a black box matcher. But they bring new execution risks born from that same transparency. Slippage, sandwich attacks, and impermanent loss. The market learned quickly. AMMs are great for spot swaps, but for high-frequency, complex derivatives, we still need order books. Which raises the question, can we put order books on-chain, keep the efficiency while removing stop hunt wicks and pulling the plug excuses from CEXs? That's the next step. In the second half of the execution chapter, we'll compare 3 order book venues: CEX, hybrid DEX, and on-chain central limit order book exchange. We'll see how an on-chain CLOB replaces the black box with verifiable steps. Follow the channel, and I'll see you in the next one.